So welcome everyone to Macroeconomics Exercise Session 3, Goods Market Continued and Money Market. We are going to see the equilibrium on the money market in this short video. Exercise 10 says the following illustration of the money market is given by the graphical representation, where you see money demand MD and MS. So the intersection between money demand and money supply, which is actually a vertical curve, is a determinant of our interest rate I star. And at point A in the graph that you are seeing, we are saying that we are in money market equilibrium. So the first question, 10.1, is explain verbally and show graphically the situation on the money market when the current interest rate is higher than the equilibrium interest rate. So we have said that we have this graphical representation where we have MD and our equilibrium point is indicated by A, and our vertical graph MS is also indicated here. We have M on our x-axis and interest rate I on our y-axis. So at point A, we have an initial interest rate which can be represented by I0. And here we have our value of money. So the first scenario is where we have an increase or a high interest rate than the equilibrium interest rate I0. So we would have a higher interest rate than that of our I0. So we would indicate this higher interest rate in a point where we can say, here we can indicate it to be I1, which is a higher interest rate. So at this higher interest rate, we can draw the line and identify 2 points where we can say A prime and B here. And at point B, we would have also a new stock of money. So this should be given as M1 here. So at I1, as you can see, our money demand, which is represented by the red line on the graph, is actually lower than our money supply, because at point B, our money demand is lower than the point of A prime on the money supply. So at this point, we have a lower money demand than that of the money supply. We are not in equilibrium. There is a deviation between money demand and money supply. Previously, we were in equilibrium where we said money demand is equal to money supply at point A in our graph. But however, we have introduced a scenario of higher interest rate from I0 to I1. So at point I1, at a higher interest rate, we have a lower money demand. And there is a higher money supply. So what does a higher money supply mean? A higher money supply on the market means excess supply of money on the market. So if we have an excess supply of money on the market, then economic agents would tend to buy bonds because they want to get rid of that money at a higher interest rate. Buying bond is actually a profitable approach. Higher interest rate, a lot of money on the market, excess supply of money on the market. So economic agents would be motivated to buy bonds. So if economic agents are motivated to buy bonds, this is again to say there is an excess demand of bonds on the market. If we have an excess demand of bonds, in an economic relationship, if you have an excess demand for a particular good, the price would so if there is an excess demand of bond on the bonds market, automatically so if there is a high demand for bonds in the bonds market, in economic relationship, if there is a high demand, automatically we would have a high price of a product. So in this case, if there is an excess demand of bond in the bonds market, we would have a higher price of bonds. Having a higher price of bonds would increase, and we would have a decrease of yield of bonds. We have already mentioned that there is an inverse relationship between bond prices and interest rate. So this is to say, if the bond prices increase, then this leads to a decrease in interest rate. If interest rate is decreasing, there would be an increase in money demand. So when interest rate is decreasing, because we are having a higher bond prices, borrowing money is becoming more attractive. If you have a lower interest rate, you would tend to borrow money. So if you want to borrow money, that is automatically saying money demand is increasing. So to achieve equilibrium on this money market and bond market, there should be a reduction in interest rate, and there should be an increase in money demand. So this is basically indicated here on the graph. First, we have said because bond prices are increasing, there would be a reduction in interest rate. If there is a reduction in interest rate, people would tend to borrow more, so the money demand would increase. So the money demand increasing would be in this direction to push us to the initial level of equilibrium, point A, where money supply is equal to money demand. What comes next is 10.2. What would be the case if we have too low interest rate? Graphically analyze the situation on the money market when the current interest rate is too low. For that, again, we would make use of our money market equilibrium graph, where we have interest rate on our y-axis, stock of money on our x-axis, and our vertical money supply curve, as we have been seeing so far. And we still have money demand, which is drawn with red color here. So we have an initial equilibrium of point A, where at this point our interest rate is indicated to be I0, and at this point we have stock of money to be M0. And now the situation that we are given is that there is too low interest rate in the market, so there is another interest rate to be set up, which is to be represented by I2 in our graph, lower than the equilibrium rate of the money market equilibrium. So at I2 we have 2 points here. So we have A prime here, and we have a new equilibrium B here. So this is basically to say at a lower interest rate of I2, our money supply is lower than our money demand. If money supply is lower than our money demand, that is, in other words to say, there is a high demand for money. So economic agents want to hold more money than supplied, so there is a high demand for money. If there is a high demand for money, what would people do? They would do everything to get money out of what they have on their hand. In this case, they would try to sell their bonds in order to get money. If economic agents are trying to sell their bonds, there would be an excess supply of bond in the market. In economic sense, if there is an excess supply of a product, the price would automatically decrease. So in this case, there will be an excess bond in the market. The price would automatically decrease. If price decreases, the yield of the bond would increase, and there should be an increase in interest rate and a decrease in money demand, so that we would be able to reach the equilibrium in the money market. So this is again to say, because of the excess supply of bonds, our interest rate is increasing from I2 to I0, and in order to reach our equilibrium, our money demand should be decreased from point A to point A prime to A.